got a money watch, and there are a lot of unknowns as we continue to get into the new year and the start of a new presidency of Donald Trump. So joining us now and every Wednesday is the managing partner and the chief investment officer of Armstrong Advisory Group, Chuck Zodda. Chuck, thanks for chatting with us. We always appreciate it.
Absolutely. Great to join you.
Chuck, we want to start, of course, with the big news here, which is the change in the White House. The market saw a Trump bump on his first full day in office. What are you expecting moving forward with the market's reaction to Trump's policies and as he is signing some of these executive orders?
Well, I think we're going to have to see what policies actually end up being enacted here. There was certainly plenty of concern heading into the week about the potential for tariffs to be implemented right off the bat. And to this point, that has not been something that has actually been put in place, though Trump has signaled that there are potentially some tariffs coming as soon as February 1st on Mexico, Canada, and even China. So I think that when you look at this, it's ultimately going to be something where there's always a lot of noise during a Trump presidency in terms of things that are discussed, but hey, how much do you actually see implemented and what are those policies? That will end up determining where markets go over the next 4 years. So I think it certainly is something where you've got to pay close attention because, you know, whether something is actually being implemented or merely discussed is a key distinction that you have to make. And so to this point, there hasn't been anything that has spooked markets significantly, but we obviously have to continue to watch to see how things develop over the next several months here as the second Trump term is kicking off.
Chuck, the fourth quarter earnings reports have been strong so far. That's obviously a positive. With earnings or the Trump presidency, or do the earnings or the Trump presidency drive the market more?
Ultimately, it's earnings that end up driving the market. And certainly, you know, in the early days here, the thought is, OK, is a Trump presidency going to be beneficial to earnings in the long term? And if so, you know, how much? And so that's what, you know, kind of drives the expectation. But ultimately, it's going to be companies figuring out how do we make more money this year relative to last year. That's what is going to drive them in, you know, kind of the longer term. And this is something that we come back to at our firm quite often, which is, look, regardless of who is in the White House, whether it's someone you like or someone that you don't like, ultimately, the bigger driving force is what companies are doing and how they are able to sell their products to different buyers and whether they are able to make more money over the long run than they were previously. So I think this is something that I kind of always come back to that helps to ground me regardless of what's going on, which is, hey, there are going to be ups and downs regardless of who's in power and what's going on in the world. There's never a perfect economy. There never has been. There never will be. But companies figure out how to manage their businesses regardless of what's going on. And even if there are short-term disruptions for 6 weeks, 6 months, a year, whatever it might be, companies are very good at figuring out how to make more money in the long run. And that's something that I come back to over.
The president vowed to end the inflation nightmare, as he called it, on Inauguration Day by signing an executive order that requires executive departments and agencies to deliver emergency price relief. Do you think this is a lot of talk? Do you think it will actually have an impact?
I think it's mostly talk. I mean, there is no way for the federal government, short of imposing price controls, which I don't think make a whole lot of sense in basically any situation. There's no way that the federal government can simply say, OK, this is going to cost less or this is going to. Furthermore, look, for, you know, all of the flaws that the Biden administration may have had as it relates to inflation, you better believe they were trying to do everything possible to keep inflation as low as possible as well. And so it's not something where you can just go in and say, yes, we want, you know, lower prices by virtue of federal decree. So I think ultimately, when we talk about pricing on products and when we talk about inflation, remember, inflation is one thing. It's how quickly companies are raising prices. And there are two sides to this. The first is, do companies try to raise prices? And the answer is almost always yes. They'd rather prefer that you pay more than less for their services and goods. But the second piece is, hey, how much are we willing to pay for those services and goods? Do we accept those price increases or do we reject them? And ultimately, the inflation that we saw that peaked, you know, kind of in 2022 and 23 It was because there was more money that was going around because of the COVID stimulus. There were huge shortages of goods. And so people were willing to pay up for those goods and services. And that's what was driving the inflation. In today's world, where we see, aggregate payroll growth running at, 4.9 to 5%. I struggle to see a world in which inflation gets back to running at the levels of 21 or 22. But I also don't think there's really any plausible path to prices coming down for any extended period of time. And usually when prices are falling, it's typically a sign that the U.S. economy is in a slide and people simply don't have the money and there's not the demand for different goods or services that there previously was.
Chuck, I know we touched on this last week. Mortgage rates, they're once again kind of above. They're hovering right around that 7% mark. Any changes kind of in the near future for people who are looking to become homeowners in 2025 under this new presidency? Or do you think those are kind of sticking right where they are?
Not right now. There's been a little bit of movement downward in them where we've gone from around 7.25 to about 7.08 today on the average 30-year fixed rate mortgage. I think that's from Mortgage News Daily. They publish daily rates in terms of what they're seeing. And I think there's a path to, hey, if everything goes right over the spring housing cycle, maybe you get those rates coming down to 6.75, maybe a touch less. But the only plausible path that I see to mortgage rates coming back down into even the fives is going to be that you have to have a significant economic slowdown in the United States. And that's not something that you really root for because even as a home buyer, you say, OK, like, great, I'd have a lower potential mortgage rate. But you also might be one of the ones out of a job then, and then you can't buy a house anyways. So I really see at this point, mortgage rates probably, ping-ponging back and forth between maybe 6.5 and 7.25. Certainly you could see some short-term moves, beyond that, but it's going to be a tough putt to get, anywhere convincingly lower unless you see a slowdown in economic activity that truly indicates, broader concern about the health of the U.S. economy.
Sure, Chuck. Yeah, it's a slippery slope. And everyone who got those, 2.5%, 3% mortgage rates during the pandemic, they are not going anywhere because that's a rate that you just cannot beat. All right, Chuck Zodda, managing partner and chief investment officer of Armstrong Advisory Group. Thank you so much for joining us.
All right. Have a good one.